Hey everyone, welcome back to the channel. So in this video, we're going to be covering HEX volatility and its price, this custom indicator we built that I'm calling volatility index, which is essentially a normalized intraday price spread. Now I'll explain all of what that means in this video. Remember, if you like this kind of content, make sure to leave a thumbs up, subscribe if you're new, and let's go ahead and get to 1,100 subscribers, guys. We're almost there. But with that said, let's go ahead and dive into this analysis. So this is my custom indicator, which I'm calling a volatility index, and it's super simple, right? The curve of the hex price here will be a hint as to what this volatility index actually is, mathematically speaking. So here, instead of charging our average price, which we're used to just looking at our average price, that's why I say we don't see wicks, but rather just daily candle data. Instead, here we're plotting the high of the day and the low of the day in this green curve and this red curve respectively. So you get your price spread for that day. Now, you see here that on the left, we have our y-axis, which is just price of hex, right? So here you have your 1 pennies, your 10 cents, your $1, and so on. On the right side, we have our normalized intraday price spread. And what is this right axis, you might be asking? Well, it's just taking the high of the day, subtracting the low of the day, and dividing by the average price of the day. So the high minus low gives you a spread, and dividing by the average of the day, you're normalizing that spread to fit on a scale that'll persist throughout time, because price will increase by orders of magnitude over time. As we've seen, we're up 100x. So to account for that, we do have to normalize the data by dividing by that day's average price. I hope that makes sense. So you get this normalized intraday price spread. And essentially what the numbers here on this axis mean are, if you reach this one level, you've essentially reached 100% deviation from the average price of the day. So you see that we actually only reached it about once over here on, what day is this? Day 9 or so. So we had about 136% move. I believe it was to the upside. And then here, let's actually look at the master sheet real quick, because I was looking at this earlier. So if you look at day 9, okay, you see that we opened at this price, closed around the same price. However, we wicked up to this almost 3x region, right? So this 3.5x or so move, right? And the average price was something like this. So we had about 136% deviation from our average price or so. So that's how you get this volatility index, which is this white chart right here. And so that was just a quick kind of raw explanation. I'm sure I could do a better explanation, but for the most part, all you need to understand for this is that this white chart is an indicator that looks at volatility on any given day. So it's your intraday volatility. Okay. And now, what I find interesting is that when you have these spikes in this volatility index, for example, you have this spike right here on day 343 of 58%. This spike here was indicative of a local bottom. And here, when you see it on day 384 or so, you see that this spike was indicative of a local top. And we've recently seen, during this local top, a spike here of 53% deviation from the average price. So does that mean we're going to go down from here? Does that mean this is a local top and we're going to see a downtrend? Maybe, but I would contend that we've seen other different scenarios play out in the past. Let's zoom in here so you can take a better look at what I'm talking about. Back here in the day 100 to day 130 or so region, you see that we had this series of 1, 2, 3, 4, 5, 6 spikes on the volatility index, all of them above 57%, ranging from 57% all the way up to, what is this one, 80% or so. So 5 spikes, this series of 5 spikes on the volatility index from anywhere from 57 to 80%, and we recently had one of about 53%. Now, these started occurring when we were testing new all-time highs back in the day. The good old days, right? So we were testing new all-time highs. We had this series of 6 spikes all along this journey from this consolidation zone around all-time highs at the time, moving up 10x into our new local top for a while. and we had a series of spikes. So could this current spike that we saw be indicative of something like this? Well, it could be too, which is why I don't like to just be black and white and say, oh well, this is the top for the next month or two, right? Because it could be something like this. Because we are currently flirting with all-time highs. We just recently had one like a week ago, and that was exactly what happened back here. And if you see overall, you can tell that we are kind of having this decreased volatility over time, which is kind of interesting. So that might explain why this current spike is 53% when the highest or the lowest one back here in this series is about 57% or so. So slightly decreased volatility, not by much, but I do think we should entertain the possibility that we could have a series of, you know, 4 to 6 spikes, just a series of spikes in the volatility index as we move out of this all-time high consolidation region. Again, could be a fractal of back here before doing something insane like a 10x move into a new local high, which would put us at around 20 cents or so. So let's be optimistic about what's going to happen, but let's not pretend we know what's going to happen. Again, your generic disclaimer for this video: none of this is financial advice. Okay, these are just mathematical models. I'm just having fun here. I love charting stuff, and I'm not a trader. At the end of the day, I know traders get wrecked, and I don't promote trading. And for that reason, is that's one big reason why I do decide to share my analysis. Because if I were trading based off these indicators that I'm making, I probably wouldn't want to share this because I wouldn't want you to front run me, right? So let my actions kind of speak for the fact that I'm not trading this market. Okay, do I have incentive to want to see this market go up? Of course, of course. But am I actively trading? Am I an active trader investor? Hell no. Passive all the way. Holders have made more money than hedge funds, right? If you forgot about your Bitcoin, for example, for 10 years, you made more money than someone who's watching the chart every day trying to trade all these moves. So this is just for fun. This is just kind of for bragging rights, I guess, to say that, yo, I predicted this possibility. I think that's cool, right? Do it for the glory, so to speak. But yeah, that's the hex volatility. I thought it was really interesting, right? Looking at this price spread, this intraday volatility. There are some indicators we can use to look at more macro volatility, which I'll probably share in a future video. And that includes things like price extension from certain key moving averages. You already saw we made one with a 20-week moving average a while back. But we have some shorter term moving averages, which provide some kind of different insight as well. So many angles you can look at this from. This is just one of many angles, right? So again, if you enjoy this kind of content, make sure to leave a thumbs up, subscribe if you're new. Let's get to 1,100 subscribers. Appreciate you watching, and I'll catch you in the next video. Peace.